Gold-backed exchange-traded marketplace continues to highlight thriving investor demand for the yellow metal. The latest ETF to make headlines is the Van Eck Merck Gold Trust OUNZ. On Thursday, Merck Investments, the sponsor behind the ETF, announced that it surpassed $100 million in assets under management. Axel Merck, President and Chief Investment Officer of Merck Investments, and the ETF joins us today. Axel, good to have you back on.
Great to be with you.
So Axel, why do you think we're seeing such soaring interest here? I mean, in mid-March, we saw that BlackRock, the world's largest asset management firm, said it ran out of shares of its iShares Gold Trust ETF. So why this demand?
Well, there are two reasons why you may want to consider any investment. One is because you have a positive return expectation, and the other one is because it may be a diversifier to your portfolio. And gold has long been a diversifier in the sense that the correlation of the price of gold is near zero to equities. And so in an environment where many people think equities are overvalued, they're looking to diversify. The Fed has inflated just about all asset prices, and gold comes to mind. And then the question is, well, why gold and not something else? Well, with interest rates being near zero still, and more importantly, real interest rates being near zero, that means after inflation, interest rates being near zero, and the Federal Reserve indicating they have difficulty raising rates, well, gold comes back to mind. And we see the interest broadening, not just the gold bugs, not just investors based on fundamentals, but then you have some technicians come in as well that see that the price action is moving in their favor. And so we have seen a steady broadening in recent months of the interest in OUNZ and gold in general.
So Axel, you expect demand to remain robust even if we have seen a slowdown in April?
Well, of course, I mean, the price of gold soared quite substantially, and we're taking a breather here. But the problem for investor remains the same, that they're stuck with a portfolio, many of them, that are overweight in what are risk assets, equities, high-yielding bonds. And if there's any correction in the market, where do you hide? And gold is just a simple answer that may work. There are obviously other answers as well. But for the time being, people are complacent again. That complacency can see to fear any moment. And if and when that happens, well, many investors, I believe, will be glad that they hold some gold.
All right, let's talk about your forecast for gold now. It's down over 1% this Thursday. Where do you see the metal headed?
Well, I don't have a crystal ball of what's going to do tomorrow. Again, what I believe is that investors may want to diversify to gold because most of them have not rebalanced their portfolios. They're overexposed to risk assets. It's difficult to diversify in an environment where, in quotes, everything may be elevated. And then, again, the Federal Reserve, which is the key competitor to gold is cash. When you get compensated for holding cash, then gold is not an attractive option. But if you believe that we might have a bear market upon us, gold might be a good diversifier. In every bear market we had since 1971, except for the one induced by Volcker in the early 80s, gold came out as a winner. And what happened in the early 80s is that Volcker put real interest rates up really, really sharply. Now, if you believe we're going to have a Volcker type of Fed, I would stay away from gold. If you think we don't have that sort of Fed, then I think gold is something investors should have a very close look at.
Good thoughts, Axel. Thanks so much and best of luck.
My pleasure.
And thank you for watching. We'll see you next week.